Good afternoon. I hope you can hear me. Um, I think last time, after covering the first two sessions on introduction to risk management and then also integrated risk management, we move on to specific risks called credit risk, the part of financial risk in a financial institution. In the credit risk, what we did was we said credit risk can be categorized into two areas, that is counterparty risk and concentration risk. Now, we were talking about counterparty means your customer making a default. That means his financial obligations are not met on time, or either interest or capital is not repaid. So we looked at different type of customers, and also we looked at the reasons for default. Then we move on to a credit process. In that process, we divide that credit process into two areas. One is credit management and the one is risk management. Credit management, we touch that customer will approach the bank and then we do a evaluation. In fact, evaluation is also part of identification of the risk, and we also use evaluation models to measure the amount of loss we may incur in case of this customer default. Thereafter, we went to different type of customers. We originally categorized the default by individual and businesses. Then we want to type of customers. We looked at retail, SME, and the corporate. So we use credit scoring models to evaluate retail or individual customers, individual facilities like credit card, mortgages, etc. Then we went to small and medium enterprises. There we looked at same, more or less, the evaluation process is actually the gut feeling and the experience of the credit analyst. So you can look at his management, his financials, how his company is doing compared to a similar company in the same industry. Then we looked at how difficult it is to evaluate because the financials are not audited, even it is audited for various purposes. Then we stopped there at the corporate credit evaluation, and I touched that corporate credit is generally evaluated through various models, and generally lenders, the bankers, approach corporate customers looking at, we call it a 4-step model, looking at 4 major areas in the evaluation. We looked at the purpose. We also looked at how he's going to repay. We call it payback. Then we looked very thoroughly about the risk, especially if you are studying risk management. We will look at the risk what our counterparty will face, which will finally result in that he is defaulting our facility. Similarly, we looked at the structure. So if I do a proper evaluation of a corporate client, we can completely rely on corporate customers' finances because they have been audited, and we actually lend based on the figures what appear on the balance sheet and the income expenditure statement. So 100% reliance on the financial statements provided by your client will be used in evaluation the corporate credit client. So we divide this into 4 categories. The first one is purpose. I want to ask you a few questions. What are the most suitable purposes which bank would like to lend to a corporate client? Now, customer in his application, he may need to mention this, why he need to borrow money from us. And based on that, you can have a pattern of evaluation suit the purpose. Now, for instance, most of the corporate clients request money for their working capital. Now, we need to understand working capital very well here, because working capital in a balance sheet is current assets minus current liabilities. So generally, your assets are financed by your liabilities. Now, company has its own equity and funding, but what is not available, we need to be balanced working capital has to be funded by banking facilities. So generally, current assets minus current liabilities will give you the amount of money a corporate client would like to borrow for his working capital. So it's a kind of a purpose generally accepted, because when you fund current assets, those current assets through its cycle of conversion, I will write on the board what is conversion. And conversion is, you have cash, then you buy raw materials, part of you will get credit, then these raw materials will be put into work in progress. Work in progress will get into a stage of finished goods. Finished goods will be sold on credit, then you will get debtors. Debtors will pay cash, you will get back your cash back. That we call it a conversion cycle. So if you have a very fast conversion cycle, your amount of working capital you require is less. But if you have a very long working capital working cycle, cash conversion cycle, you need working capital. So most of the companies, especially manufacturing sector, need working capital, because they have to buy raw materials, make the goods. Goods will be stored in the stores, then you sell for credit in order to have a better advantage of trade. And those credit will create debtors, debtors will pay cash. So that take a longer time. During that time, several cycles of production will take place, and those productions need to be financed. And as a result, you need working capital. So any company, whether in trading or manufacturing, who maintain stocks for the purpose of sale will encounter working capital deficiencies. And this working capital deficiency will be one of the purpose for them to borrow money from a financial institution. If I would say, the other purpose is to finance an asset. This also very common, but working capitals are given for very short period of time. Generally, working capital facilities are like overdrafts, short-term loans, revolving import loans. Those are working capital lines. Bank would generally prefer to undercorporate with working capital, because those monies will be paid in a very short period. When a company need to fund their fixed assets, land and building, machinery, plant, etc., they need to borrow on a long term, because the cycle of depreciation also differ. At the same time, if you have done project financing, you may have done internal rate of return. So internal rate of return, if it is positive, you accept that project. And the duration of the project, where you recover all the money is what you have been invested is the time period you require to pay that loan. So generally, financing of fixed assets need to be done by term loans. Term loans can vary from 2 years to 7 years, that duration. So that's another purpose where you corporate borrow money. Now I want to be a little bit controversial. If a corporate client comes to you and say, I need to settle a debt or an outstanding in another financial institution, I need to borrow money. Here you can chat with me if you differ with my decisions, because I identify three purposes where corporate borrow. One is working capital, one is financing of assets, fixed assets, the other one is settlement of liabilities by a corporate. So this request of settlement of another outstanding in another bank is made to you. Imagine you are a credit officer and your corporate clients come and say, look, if you look at my balance sheet, I have 100 million borrowing from Bank B. Bank B is a competitor bank of ours. I want to bring that loan also to you and settle them in full. What would you say? In my previous presentation of this purpose, I got varied of answers for this particular request. Financing to settle liabilities, or financing to settle outstandings of another financial institution, or if a director has funded this particular company by way of a loan, payment of that director is the purpose given. So it's a settlement of liability. Generally, banks are a bit reluctant to engage in this purpose. However, I told you in the beginning, we are actually funding based on the balance sheet. So if this particular customer, if he had borrowed money from the bank A or B, it will appear as his borrowing in the balance sheet as a total. So if a bank A wishes to absorb what the bank B has given, there won't be any change in his balance sheet. And there's no change in the exposure of customers' liabilities. If customer can borrow from B and A same amount, and if A to finance the amount outstanding of B, is not going to change the customer's indebtedness or the liability. Therefore, this purpose also in order, provided that this particular customer is regular in payment to his other financial institution, and he has, we are going to look at next line, which is payback. He has the ability to pay back that loan. It's always better to take it. Most of the customers do this for the purpose of interest rate advantage. If they have sign up a loan previously with a bank A, or I will say 12%, and the interest rates in the market has come down, and you bank B now provide facilities to this customer at 11%, they looked at the two facilities taken from both banks, and then they might propose to you, I have a loan with a competitor bank. They might not reveal you the interest rate, but they will say we would like to bring it to under one umbrella, and they will suggest we will do that provided we can get an interest rate of 11%. So company does this particular purpose in order to get a financial revenue increase on their books. So this purpose also in order. So when you discuss the 4-step model, the first is purpose of a corporate client. So it can be a working capital. Working capital also has to be measured by reducing average assets, reducing average liabilities from average assets, to determine the working capital. Then you can also finance fixed assets by looking at internal rate of return. That means the project is viable by purchasing these assets, and also under internal return, the duration what you taken into account could be the duration for your loan facility. Then I will also discuss in detail about settlement of outstanding and other bank or settlement of liability. So these are three purposes which lender generally take as reasonable purposes to lend to a corporate client. Now I will look at payback. Payback is your repayment. Corporate clients, how does corporate clients repay? We'll take for an example, corporate clients, they have in their income expenditure statement, you have top line of sales or revenue, you deduct the cost of goods sold, then you get gross profit. Gross profit is the margin you have for buying and selling. Then thereafter you deduct all your administrative expenses to arrive at the net profit. So this net profit realization is, we call it, your cash flow profits. So generally corporates pay their installments, pay their bank liabilities or the financial obligations with cash flow profits. Profits which made of only the book entry, which cannot be used to pay back bank installment. So I would say cash flow profits. Some company may propose to you, other than cash flow, I intend to settle your facility by way of a liquidation of assets. Now, when I say this to most of the audiences, they get a little bit jittery. Generally, in personal capacity, person sell his assets because he has no way to pay back. So you consider as a liquidation or bankruptcy or whatever term you call it. But in a corporate, sale of assets which are not being used for actual generation of revenue is worthwhile because those assets are not going to contribute to your top line or the revenue. How do I explain in an example? We'll say you have a company. Company property has a extent of land, say 1 acre. But you have, the company has built his factory, car park, etc. what you use for entire operation is ½ acre. What happened? You list the total value of your building, land and building as your assets in your balance sheet. And actually to see, part of the land is idle, not generating any income. Probably in Sri Lankan terms, it may be adding value at a later date. You may be able to revalue and add a revaluation reserve, but it's a different thing. If you have any other assets, even building which is not being used, or any machinery which are kept idle, are assets which actually companies not using to generate income. Now, if someone says, I'm going to liquidate assets, the next question the banker should ask is these assets are required to generate income? If it is so, sale of assets means he is into bankruptcy. But if he has additional assets which doesn't generate income, sale of those assets will bring in more funds to the company. So on the accountant's point of view, sometimes accountants say assets are bad, because actually I would say idle assets are bad. Idle assets, it doesn't generate income, will be have only in our book. Therefore, sale of that to generate cash and pay back your liabilities, which are interest earning liabilities or interest payment liabilities, will save you more money. So payback can be cash flow profits or sale of assets which are not being directly used for your current generation of income. Now we move on to the other area, which you, in your evaluation, now you looked at the purpose, you looked at how it's going to pay back, which is not sufficient. But you also need to look at what risks this particular customer may encounter, and those risks will finally result in default of facility. So our course is also for risk management. Now we are deviating from bank risk to look at our counterparty risk. That means our customer's risk. This customer's risk is very important to analyze, simply because based on those risks, customer may suffer a loss. When he suffers a loss, he will default our facility, creating a credit risk to the bank. So I'm going to go thoroughly on the risk part of it. Thereafter, once you analyze the risk and you determine it is risky or acceptable risk, you can also structure facilities to create that risk, part of a risk mitigation. Now, for instance, initially I said if the purpose is working capital, bank would like to lend because it's short term. So bank need to identify what are the short term needs, what are the long term needs, and based on that identification, they need to structure the facility. Now, for instance, structuring means you actually give different type of lending products to a client. His short-term requests or the purposes will be funded by overdraft, short-term loan, revolving input loans, so on. His long-term purposes like asset financing will be funded by long-term loans. So that is, we call it structuring. So when the cash flow for the company comes, you have structured according to the facility. So all the repayment coming out of his business will be from cash flow profits. It's similar in a simple exercise. You lend to a farmer, and if you expect that farmer to pay a monthly installment, he may not generate income monthly. He will only generate income only he does the harvesting. So you need to structure his facility to collect the total value of the loan inclusive of interest at the time of harvesting. So you need to structure the loan for 6 months duration or 1 year duration, the time when he harvests his, or whatever the time. If it is paddy farmer, you have yellow, you have maha, based on the duration you take to plant and reap the harvest, that's the time you require to collect this facility. So since we are on a risk management, I'm going to go a little further into the risk faced by our clientele or our counterparty. These are not bank risk. Bank risk we will discuss in our risk management, but this is related to credit risk. Credit risk will originate when customers face various types of risk to default the bank. First one is, we call it a financial risk. Like we face credit, they also can face credit. They also can get into a liquidity crisis. They also will have various risks related to finance, source of funding of their businesses, so on. So financial risk will apply to our corporate clients. Then on the screen you can see macro conditions. Macro conditions is in the business economic environment they operate. Nowadays Um, we are struggling with COVID-19, and as a result, we have enormous number of macro conditions created. As a result, economy is down, GDPs are down, exchange rates are fluctuating, interest rates are fluctuating. Uh, so macro conditions, we call it very volatile in the current situation. So these things will affect the business. So we will discuss that. The management and ownership also another part where customers mismanagement, they result in a loss situation when they or customer divert funds out of the business for his personal purposes, customer can go bankrupt. So ownership and management is also another part of risk. It's a qualitative factor which we will analyze and see how corporate customers' qualitative factors will affect. Then certain businesses have their inherent risk. That's why we need, when you fund a corporate, we need to analyze their business well. We need to analyze their cash flows cycles. We need to see whether the product has a competitor, they have an advantage in the market, their volumes are sufficient to cater to the demand, so on. We need to discuss their business risk. So based on that also, customer could get into crisis. Like if they're relying on one raw material supplier and suddenly he refuses to submit raw material, they will have to stop production. That sort of area is their business risk. So these risks, these four types of risk that may jeopardize repayment will be discussed in details. So we look at financial risk based on lender's approach. Financial risk measure the stability, flexibility, variety and cost of company's funding structure to determine the value of an advance, rate of interest what you are going to apply to that advance, and collateral cover we are going to propose in order to mitigate risk coming out of this. So financial risk evaluation is a quantification of customers' risk. Anything that can be given value in money terms, monetary terms, will be checked under financial risk. You may have done this ratio analysis for liquidity, solvency, funding strategy, funding instruments. Nowadays, corporates not only can borrow from banks, they can issue commercial paper and borrow from other money market players. So they can use various type of instruments, issue debentures to raise funds. So we need to also analyze funding instruments. Then we looked at company's efficiency, how fast it can turn their current assets into cash. Then we need to also cover whether the company's borrowings, at least they can have debt service cover or the interest cover. Then finally, it's profitability, because without profits, they may not be able to pay your loan. So these are some of the financial risk evaluators, and these evaluations are done. And next time I will do a slide on this week, and I could get I could download some companies for you to practically show this. But next time when we meet on online, I will do a slide which I will download for corporate clients, or 2 or 3, 4 clients, and their results, and see how they are practically, their liquidity, solvency and profitability at least will affect the risk in repayment of facilities. So we'll look at next slide. You may have done this for your other modules need to understand where risk is concerned. Liquidity means company's ability to convert current assets into cash. Um, so you remember in banks we have this high quality liquid assets, which is a measurement divided by net outflow of cash liquidity will be give debt service or liquidity coverage ratio. That's how we measure in banks liquidity. But if you are doing it on a company, their current assets are different from a bank. So their current assets include cash, the debtors, and stocks mainly. So if current assets is higher than current liabilities, this particular company need working capital. That is on the funding line. But it will give strength where liquidity is concerned, because these current assets are going to get converted into cash quickly. Will provide sufficient liquidity to pay their current liabilities. So higher the current assets you consider as a good sign for a company. Generally, bankers believe in old tradition ways, we put a benchmark for this current ratio. Current ratio is current assets divided by current liabilities. If you have 2 times of current liabilities in current assets, you think they are very well, they manage their liquidity very well. So current ratio 2:1 will give a lot of leverage for company to convert those current assets into cash and pay their liability. So generally a banker would like to have 2:1. But with my experience, I'm telling you, certain business models doesn't require that amount of money in your kitty, because you don't need to settle liabilities that often. Sometimes companies may take raw materials or supplies for 90-day credit. So they are not in a hurry to pay. So they don't have to convert their current assets into cash immediately. They have a period of 90 days. One single debtor can be settled. So those are different business modules. Some will not have a long cash conversion cycle. Some of the business models are prepaid. If you want the services of a company, they will say, okay, you deposit money, I will deliver you. That means you don't need funding, or you don't need to convert that debtor into cash. You have got cash even before you provided the service or the goods. Those companies, their current ratio is not 2:1, because their current assets are much lower than current liabilities. So there are different business modules. To explain to you this in very much detail, I may need to actually download at least 2 or 3 companies' annual reports, and then go into the finance section. Then I will take the financial highlights to work out a current ratio, which I will do it next time. So for the time being, we will say current ratio is current assets divided by current liabilities, and bankers' general acceptance is 2:1. That means current assets are twice the size of a current liability, which will give a lot of leeway for a banker, leeway to the customer to sell his current assets and create liquidity enough to pay his liabilities. So current ratio is one of the liquidity ratios we generally looked at customers' financial risk. Then we also have this quick ratio. Quick ratio is same current assets. You take out inventory. Inventory means stocks, and divide by current liabilities. So you are actually breaking down your cash conversion cycle. That means You borrow money, you buy raw materials and create creditors. That means you buy on credit. Those need to be settled. Then there will be a process where you go into work in progress and create stocks. These stocks cannot be sold immediately, therefore they will register in your current assets as inventory or stocks. That total amount what is being booked there, if you reduce that from your total current assets and divide by current liabilities, will give you a ratio called quick ratio. Now, originally I mentioned liquidity is measured by a current ratio. Current ratio 2:1 was generally acceptable to a customer. Quick ratio 1:1 is good enough, because if you can pay your liabilities without taking into consideration the stocks you hold, because debtors get converted to cash immediately. As a result, if you can use only the outstanding of debtors to pay the liabilities, you are still sufficiently liquid. You have sufficient liquidity. So therefore, this quick ratio is another measurement you use to look at the liquidity. So we'll look at the solvency. This solvency is looking at the capital provided by the client to run the business against the money what he has borrowed from the financial institution. Is the guideline for looking at this particular ratio. We call it solvency test or gearing, or some may call it leverage. So gearing is generally in bankers' term is long-term liabilities or debts divided by shareholders' equity. You compare the amount of money which company has borrowed on a longer term in order to do financing of fixed assets. If that is been divided by shareholders' equity, we call it a debt equity ratio. So we also call it gearing. Generally, a banker would like a debt equity ratio is 3:1. We looked at this when we compared a corporate and a banker in our first session. In that we say the debt equity ratio of a bank is about 9:1. Where a company you will not fund if it is 9:1, because he contribute 1, he asks the banker to contribute 9. Generally, banks in their project financing arm, maximum they will go is 3:1. That means bank will fund 75% of the project and the customer will bring in 25% of the total capital requirement. So this method will give us a stability. Actually, more the capital which the company bring in, the less chances are that company can default. So higher the debt equity ratio means higher the borrowing from customer compared to his shareholders contribution. So higher the debt equity ratio means higher the risk. And therefore we looked at this on the risk point of view, and we would like to have higher contribution from the shareholders so that they have a stake. They will work very hard if their stake is high in order to make profit, because then the shareholders' interest will be looked after by way of a higher profit. However, most of the companies now doesn't stick to long-term borrowing because of interest rate changes, various other things. They prefer short-term borrowing. Even sometimes if they have to fund a long-term financing of fixed assets, they will say, okay, we have sufficient cash, we don't want such a big loan. As a result, bankers found it difficult to compare only the long-term liabilities against shareholders. So some banks include current and long-term liabilities divided by shareholders' equity to look at the gearing. This is the ultimate test, but If you can have a 3:1 debt equity ratio, bankers are generally acceptable to fund the facilities. Now we looked at a very important ratio called profitability. Now I will go to the board on this because this need to be explained with the sample income expenditure statement or the trading account. So we'll put it this way. I hope you can read the board. In this board, what I have done is a sample income expenditure statement of a counterparty. You sell, then you deduct cost of goods sold to get gross profit. And then you deduct from the gross profit, selling and administration, you will get earnings before interest, tax, and amortization and depreciation. So EBITAD stand for earnings before interest, tax, amortization, and depreciation. Then once you deduct that from that depreciation and amortization, you will get earnings before tax, earnings before interest and tax, EBIT. If you deduct finance cost or the interest from that, you get earnings before tax. And when you pay tax, finally you get net profit. So this is a sample revenue account. So we'll go back to our slide once again in computation of profitability. This is where we stop. We said gross profit margin. Now you look at it, gross profit margin is gross profit divided by sales. Now, if I to go back again to the board, I will draw something else. Here I will write so I will do some comparison of companies. It's a company A, B, and C. You have gross profit, you have net profit. This is 35%. Or we'll put the same company in 3 years. Year 1, year 2, year 3, company A. This is 25%. This is 36%. You have NP 10%, 11%, and 8%. You can note down my second writing on the board, which is a company A. We are comparing the company A's 3 years financials. Now, 3 years financial means we have year 1, year 2, year 3. Now, if you divide gross profit by sales into 100, will give you a gross profit margin, which is generally set by way of a percentage. So the year 1, this particular company, if you can see, has 35% gross profit. Second year, the gross profit reduced to 25%. And the third year, it has rose again to 36%. Now, when you do financial analysis, now you are into profitability calculations. In that, the first one is you looked at the gross profit margin. Gross profit margin is arrived at gross profit divided by sales, and we have got these figures: 35%, 25%, and 36%. Now, as a credit analysis, what do you think about this customer? Aren't you curious to find out why this variance is? Actually, if you are evaluating or doing financial ratio analysis, these sort of variances need to be verified with the company directors. Reasons I can give you some are: company generally in good times, their industry maybe will generally make 35% gross profit. That means you always keep a margin from purchase of your goods, and when you sell final products, you have all the expenditure what you spend on that product less. You have a 35% margin. Maybe for industry to industry, this margin generally get change. Now, Reserve Bank of India, in India, they have actually analyzed various industries and arrived at the best companies' gross profit margin, and they generally pass that on to bankers to make their evaluations. So, if you say pharmaceutical industry, generally they say they have a gross profit margin of 35%. So, if you are evaluating a customer and if he is getting 25%, that means either he's buying his raw materials at a higher price, or he has not much negotiation power with his suppliers. So the suppliers are demanding higher value for the raw material. So you need to benchmark them. But in Sri Lanka, since we don't have those ratios publicly available, what we generally do in a corporate analysis, we take the customer's 3 years financial, and we arrived at like this: a gross profit margin of 35%, 25%, and 36%. You may need to verify, when you arrive at a situation, that you need to verify from your client what it made to record a lower gross profit margin in the year 2. You might say there was a shortage in the world market of raw materials, and we had to buy at a higher rate. As a result, the margins drop. Or you can say your purchasing officer got resigned, and thereafter you have to look for new suppliers at a higher price. So some reasons he will have to give, and while he is bringing back to 36 means they have worked out the problem. So in risk point of view, the risk of lower profit has been eliminated in the year 3. So this is how the risk managers looked at it. Now gross profit. When you have 35% gross profit, you record 10% net profit. But despite you are having 25% gross profit, you record 11%. Now this is a very peculiar situation where, you know, your gross profit has reduced, but you have maintained high net profit. What it matters is the net profit. So this also need to be put on inquiry. How do you do that? Is you need to ask, how do you achieve it? Probably they may have discontinued their discounts to their suppliers, or they have reduced their costs drastically along with the lower gross profit. Companies adapt various methods like reduction of staff, outsourcing their various activities. Instead of having their own fleet of vehicles, they hire vehicles. So those sort of things where revenue increase methods they may have adapted. As a result, they would have got. So you, as a banker, you need to query all that. Otherwise, this doesn't sound reasonable. Now, despite you are recording 36%, now you have gone to 8% net profit. This also need to be queried. Your selling and administrative costs may have gone up. Your staff salaries may have gone up. If you have borrowed money to expand business, you will be paying high interest and large finance cost involved. These things may reduce your net profit further, or the government taxes have increased in your particular industry. It could be anything in between these lines. So these need to be queried. So profitability is a check where so we looked at gross profit margin and net profit margin. Now, company have two types of profitabilities. How profitable is your sales? Now, in this example, what we looked at our board is what we have looked at, how profitable are your sales? What is your gross profit margin and what is your net profit margin? But we also need to evaluate in our profitability of a customer with some other criteria. You can even check your profitability of sales by operating profits divided by sales. So you can have GP margin, you can have operating profits, you can have NP divided by sales. All will give you how profitable is your sales are. That means you incur manufacturing or buying item for 100 rupees and then you sell for 75 rupees. Then gross margin is 25. If you have incurred another 15 for your administration and various other activities, then you have 10%. That is your net profit. What we have looked at is what we have sold based on revenue. Now we have another measure. Overall company's profitability is also measured based on how much assets you put in to run this business and how much return you got for those assets. So we call this ratio to evaluate how profitable is your company is, we call it return on assets, ROA. ROA is calculated net profit divided by total assets. What we are looking at is very simple. In your balance sheet, you have your total assets. In your income expenditure, you have the bottom line, which we call NP. NP divided by total assets will give you how much of single rupee you invested in your company and amount of cents or whatever, more than a rupee, you generate out of that. So if you have in your balance sheet so many assets which are not contributing to your NP, you can have a very large asset base or a large balance sheet, but your profitability will be low. Your sales are profitable, but your return on assets is not the utilization of entire assets which you have recorded in your balance sheet. This happens, as I explained to you earlier. Company can be located in the land, only half is being used for operation. Balance you cut the grass and keep it for beauty or whatever, protects the environment. Or you wait for another future given date, so you could revalue the entire assets and add up those revaluation reserves to your balance sheet to enhance your balance sheet. So generally, I told you, return on assets is a measure we looked at. Therefore, we would like to fully indulge all our assets in revenue making aspects so that return on assets will be higher. Return on equity is the other one. NP divided by shareholders' equity. Now say companies are generally funded with shareholders. These shareholders could deposit their money in a fixed deposit and earn a fixed interest. But why they invest on companies? They want high return. They want a higher return than what you put into a bank. So generally the return on equity should at least give a higher return than your fixed deposit rates what the banks offer. So to make that, you need to make more your bottom line higher, that is your NP is higher. That's what the shareholders' expectations are. So shareholders' expectation is a higher return on equity. So this is how you evaluate the profitability. We need to verify their sales are profitable. So the gross profit and net profit should be positive. Otherwise, they will not be able to repay you. Then you also must make sure company also overall making profits, utilizing the total assets they have in their balance sheet. So companies which use assets to the maximum make generally higher profits. As a result, their repayment capacity is high. So this is a very good exercise for us to see when you're funding a customer, to look at two type of profitabilities of this plan. One is to check how profitable is this client sales, and we also looked at in overall how profitable is customers utilization of assets. Now we can also move on to efficiency ratios to look at repayment capacity of a client or efficiency of a company will lead to non-default of facilities. Asset turnover ratio. Now, earlier I divided by NP divided by total assets to give return on assets. Now, this is another ratio, asset turnover. You use assets to generate sales, and higher the sales you generate utilizing your assets will give you a high top line. When you have a high top line, even if you deduct all the expenses, including selling and administration, cost of goods sold, depreciation, still you will end up with a high NP. So return on assets will also efficiency measure that we can see that when the efficiency is high, companies doesn't default. Debtors turnover. Now, generally companies, either they can decide to sell for cash or they can sell for credit. If you sell for credit, in their balance sheet, they are creating a debtors. Now, your total sales divided by debtors will give you a ratio called debtors turnover ratio. If your debtors are high, even your sales are high, you will get a lower debtors turnover ratio. Higher the debtors turnover ratio, your efficiency levels are high. Your ability to convert debtors into cash is also high. So therefore, most of the companies have a policy on credit, and they will say our policy on credit terms for their customers can be 30 days or 60 days or whatever. So you need, when you are a banker who is financing a customer who sell on credit, need to get this term of credit to their customers. And if any outstanding in your debtors exceed this term, that means they also find it to collect their debtors. As a result, their efficiencies are lower. When the efficiencies are lower, the vulnerability to repayment also will occur. As a result, the risk is high. So it's another measure we will look at is higher the efficiency ratio of debtors turnover will give a customer ability to repay. Inventory turnover. Similarly, you divide cost of goods sold by your stocks, will give you a turnover ratio which will specify the amount of time you keep your stocks in your godown or in your stores. If you had to keep your goods in store longer period, that means your efficiency levels are low. Faster you turn your stocks, higher the cash flow you're going to get. When you have higher the cash flow, you have ability to repay your banking facilities. As a result, you are having lower risk. Such customers who have higher debtors turnover, higher inventory turnover than the credit terms and stock level periods what they have in policy will do better and are in a position to repay the loans faster. Creditors turnover, of course, you can take time because this is what the accountants are doing in most of the companies. They will delay as much as possible in payment to their creditors or for the purchases, but recover the debtors and turn their stocks into debtors or cash quickly as possible. That way, efficiency can be maximized. Fixed assets utilization. If you also, another measure of efficiency is it's not worth for a company to buy all the machinery and dump in their plant. They must only look for machines which are immediately required for the function of their business. So sometimes if you have fixed assets in your balance sheet are not being used for production, those will reduce your efficiency and lead to losses. So therefore, efficiency is to have the right amount of fixed assets, because fixed assets need funding. Funding will come by way of bank borrowing, and bank borrowings become non-payable if those fixed assets are not generating sales. So that's another measure. So efficiency ratio is also a very important factor to identify the risk that may offer, financial risk offered by your counterparty. Now we go on to a scoring method. Now I discuss lender's approach. Lender's approach is the 4-step model. That is, you looked at purpose, payback, risk involved, and structuring of the facilities. Now, there are certain credit rating agencies only looking at the financials of the business also can predict their creditworthiness. Such a rating agency is called Moody's. They have developed something called KMV RiskCal, which will give a kind of evaluation of corporate clients. So what they looked at is similar to what we have looked at in our financial ratios. They look at profitability ratios. You remember we looked at how profitable are your sales, how profitable are your company. In company, we looked at asset turnover ratio, and we looked at return on assets, then return on equity. On the sales side, we looked at gross profit, net profit, and earnings before tax divided by sales divided by earnings before tax. So various measures we looked at to look at the profitability. So what this risk scale is, assume higher the profit, lower the default probability. So if a company is making higher profit, the chances are that he's not going to default. So how do you look at higher the profit? You may need to benchmark against the similar industry or the best company in this industry and how much that particular company made. If you are close to that, you also can survive in the market. So profitability ratio is kind of they say higher the profits. That means you are having a high level of profit close to the benchmark of the best client in the same field. Then leverage ratio. We also looked at leverage ratio. Higher the leverage, that means higher the debt equity, increases the probability of default. Now they are looking at in a other way about it. That means if your debt equity ratio is high, the chances of default is also high. So we looked at in our solvency test, bankers would like to fund 3:1 debt equity ratio. So if this ratio moves upwards, that means instead of 3:1, it moves up to 5:1. That means risk is high of this client. So we need to get customer to contribute to majority of his business to reduce the risk of default. That's why when customers request enhanced line, we ask this question from corporate clients. Is there a possibility that you could increase your equity or increase your contribution to the business to keep something similar to debt equity ratio what we currently enjoy? So higher the facility he proposed will be partly his funding of his own. That way we reduce our risk. So higher the leverage or higher the debt equity ratio, chances of default are also high. Then generally we looked at 3 years financials. Now we have two financial statements in which we looked at various key aspects in the financial statement. I have put on board earlier the income expenditure statement. On that top line is sales. If when you're comparing 3 years, if sales are declining or in your balance sheet assets are not growing, then there is trouble. Then there is a growing chance of default by the client of the facilities what he has taken. That means if the sales are declining, your profits are going to get affected. And when your profits get affected, your cash flow profits, your ability to repay will also get affected. And the risk is, if a company is continuously growing, enjoying higher sales, assets are being increased year on year, then stability will come into the company and the risk is low. So you looked at in this risk scale the profitability, debt equity, and also growth. Growth is year on year increase in key indicators. The fourth one we looked at in our example as efficiency ratios, but in Moody they call it activity ratio. In that they can measure bad debts, stale inventory, and production problems. That means if debtors are turnover is low, that means you may have bad debts. If your stock turnover is becoming low, that means some of the stocks are not moving. And as a result, you will have a stale inventory or bad debts on the debtor side. Or you have production problems generating longer period to get finished goods into your stores, and then as a result your cash conversion cycle become longer, so efficiency will become lower. So activity ratios also will help Moody's KMV risk cal to identify the risk. If activity ratios are not good, risk is high. Size. Sales and total assets are determinant of default probability. If a company is increasing year on year its sales, we assume he is increasing his profits also year on year. If total assets are getting increased, that means he is adding value to his balance sheet. And we have used the balance sheet as our main judgmental instrument to fund this particular company. So increase year on year is the size of sales, size of assets. If that increases, company's risk is low. So based on these 5 areas of quantification of balance sheet, risk can be assumed by, we can give a score to each area and arrive at a total. And if the total is matching a benchmark like what we did credit scoring, above that, we think the customer is creditworthy and facility could be granted. So this is another method of calculating or evaluating a corporate client. Now we will move on to the business risk. So far what we have looked at is the financial risk. Financial risk, we looked at the ratio analysis. Now, business risk are different, are sometimes inherent to different type of business. Some business models provide a customer competitive advantage, and some businesses doesn't provide that. Now, for example, I can take 2 businesses in the same field. We'll take 2 companies like Dialog and SLT. Okay, I'll use these 2 companies to do that comparison also of what I promised you earlier, to work out the annual reports of these companies to arrive at the creditworthiness or the repayment capacity of the clients, and various financial risks we can assume by looking at their financial positions. As far as I know, Dialog make much higher profit than its direct competitor, SLT. Sri Lanka Telecom is a huge company. Their asset base is maybe twice the size of Dialog, but Dialog make more profit than Sri Lanka Telecom. Simple reason is their business strategy and the business model. So if you have a good business model, you tend to create more profits, and when more profits means default risk is low. Now, what is the business model adapted by Dialog comparative to SLT? Dialog, most of their businesses are done upfront. They have very less postpaid packages compared to the prepaid packages. When you have prepaid packages, you will be getting your money even before you providing your service. Now, you know, most of Sri Lankan holders of mobile phones are operated on that small card what they buy in boutiques, and those cards are, you paid for the card and you come and swipe the card, or you take the number out of it and input it, and you get data, or you have the call facility. And the amount is deducted based on the number of calls you make. But you have already paid for the full value. Now, SLT has a different model. They will bill you after a certain period, say 1 month. Thereafter also, they give a date for settlement, probably another 2 weeks. So generally, you have already used the facility. Even after using your facility, you get another 14 days to pay. The facility what you use, the services what you used first of the month, in fact, you have to pay after 45 days, that means 15 days after the following month. Who bears the cost? Cost is borne by the service provider, which is SLT. Compared to their competitor, who has already collected the money before providing the service, have that additional cash which they can generate more income. They can even put that money into a bank and earn interest. So that kind of strategy of a different business model will create lower business risk. If you had to collect money on a loan, there are chances part of those clients will default. So strategy, in business strategy, will give you low or higher. Earning dynamics. Company, I told you in our example, you have a gross profit of 25. Still, you make a net profit of 11. That is your earning dynamics. That means you maximize your cost, minimize your cost, and maximize your profits. And you create quicker cash generation cycle in your cooperation. So earning dynamics, also the ability to earn more will reduce the business risk. Asset management, we looked at. Asset management are asset turnover, or asset management efficiencies. When efficiencies are higher, business risks become lower. So you looked at the business risk, it can be based on the company's strategy, the company's earning dynamics, and the company how it manages assets. And companies will reduce the business risk by these 3 items at a lower risk of non-payment. We looked at management and ownership. It's a qualitative aspect. Actually, this cannot be quantified, not like the financial risk. We looked at the strategy in the business risk. If the business strategies are good, if financial strategies are good and the performance goals are achieved, those companies have a smaller or little risk of ownership. That means management is firing. When management is efficient and active and work for the purpose and create higher sales, then the risk become low. The other one is structure. Now you take a situation in a bank. The structure of a bank is, I would say, it's a hierarchical. From a banking assistant to become a managing director or the general manager, it takes a very long time because you may have to surpass so many steps, becoming a staff officer or junior executive, becoming executive, then you become assistant branch manager, then you become a senior manager. We also have a title called chief manager. Then we go on to assistant general managers. Then beyond that also we have deputy general managers. So this ladder of moving up will not take that smoothly, take great effort in the structures. As a result, you have higher staff numbers in each layer. When you have that, your costs are going to escalate. When your costs are going to escalate, your ability to make more money will get reduced, profitability will get reduced. When profitability gets reduced, what will happen is risk of non-payment will occur. So you need to create, your customers need to create the correct structure of management, and to have right people. We generally say it's like, going in a bus. You need to get a good driver who will be the managing director, and he may need to fill those seats with engineers, with technicians and various other things, so that even if there's a breakdown halfway, that they will make it and go. So you need to have a ongoing business, a continuous business, which you can achieve through having correct staff and putting them in the right structure. Then you also need to look at systems. Companies which has good processes and good computer systems which can manage risk and help the business processes to have high productivity, then they will have higher profits. When they have higher profits, lower the non-payment, and when there is no non-payment, it is part of the risk. Then companies also will thrive based on the skills and the experiences. Generally, companies would like to have a COO who is very experienced, Chief Operating Officer. Some companies have the best CFOs, Chief Financial Officer. Some companies have CRO, Chief Risk Officer. So these officers are going to create a management team with a lot of skill and experience to guide the company to get high profits. So when you look at the organization chart of a company and identify their skills and qualifications, you will come to know in your evaluation that this company's management and ownership risk is less. As a result, they will repay the loans that they borrow. So risk is become lower. Now we move on to the last aspect of the risk. We discuss financial risk, we discuss business risk, we discuss management and ownership risk. Now we need to look at the economy which our clientele operates, or the business environment our counterparties do their business. Those environment also may provide them various type of risks. Major risk is the market risk. These companies are relying on raw material. Now banks need money. If the economy is not doing well, it's very difficult to get deposits. So our raw materials of money will not be supplied in abundance if the economy is not doing well. Similarly, if a company is engaged in manufacturing and the raw materials are fluctuating in price, they will find it difficult to fix the price of their finished goods. And by fixing, they might even run into loss. To operate in the economic environment, they need to borrow money. And if they can borrow today at 10%, and tomorrow the rate of interest goes to 12%, and if they have already borrowed their requirement, I would say they have taken the best advantage of interest rate, provided they have borrowed at a fixed term. Now, bankers know the risk of this. Bankers know how the interest rates fluctuate in the economy. So they prefer customers to borrow on floating interest rates, so risk can be minimized. Then the other factor in market risk is exchange rate. If your clientele is either importer, and if we depreciate against the currency which he used to import, we'll say when dollar is 180, he established LC. By the time goods come and he has to settle his liability of LC, he need to pay at the rate of 190. So each dollar is losing 10 rupees. That will add up to the loss. And that will create a market risk. We call it losses related to exchange rate fluctuations. And when this happens, his ability to repay will get affected, and his collateral value, if it is marked in rupees, also will diminish against the exchange rate. Then another factor in macroeconomic is the liquidity. Now these days, government is pumping liquidity through banking circles in order that they can lend to businessmen. Because we are kind of after COVID-19, we are heading towards something like recession. That means consumerism is going to get affected and people are not buying things, people are not producing things. As a result, economy might collapse, because economy to move, we need to move our gross domestic product. And here what we are going to do is look at this liquidity in the economy. General liquidity in the economy is part of the responsibility of a central bank. They can squeeze the money in the banking circles by way of issuing treasury bills and bonds. They also can pump money to the banking circles by reducing the liquidity risk parameters and also providing various rebates or providing facilities to a different type of industry which they want to promote. So liquidity risk in the market is also will affect a part of macroeconomic risk we may have to consider. Strategic risk is the competitiveness of, if your product can compete in the world market, sure the default of your facilities are very low because you will get orders, and those orders, once you execute, you will create profit. Environmental risk. You also have several issues nowadays. We have election coming up. As a result, we have serious political issues. Then also, COVID-19 has allowed various social and health related risk. Now we may not be able to, socialize in the society in order to adhere to health instructions. So they say you need to keep social distancing of 1 meter from each other. That will create in the environment where people, people will not gather in places, they will not socialize, they will not have functions. All these are areas where if your client is involved in such functions, his earnings will get deterred. His earnings will become lower and chances of default will occur. Legal and regulatory, also another factor in the environment we operate. Sometimes we take example like central bank imposing 100% margin on importation of cars. What will happen is anyone who wishes to bring down a vehicle has to pay upfront. When that happens, your customers who are in the same type of business of vehicle imports and sale, their business will get affected because number of sales calls they can do get reduced. As a result, their profitability will come down. So legal and regulatory risk also will affect our clientele. And when that affects our clientele, if you have borrowed money, the credit risk will be set upon the bank. And to avoid that, we need to evaluate the credit risk of a client well. So these are areas where we looked at, and now we need to, since we have identified various risks affecting through evaluation process, we looked at purpose, we looked at repayment, we looked at all type of risks. Our customers, they get entangled, and those risks can be minimized. We can reduce the cost. Banks have a way of minimizing the risk. What they do is they use 3 aspects: covenant, collateral, and price, to minimize the risk, or we call it mitigate the risk of non-payment. I need to explain these 3 items in detail. To take covenants, covenant is a pledge or promise between 2 parties for performance under contract. It can be financial or non-financial. So we'll look at in detail. Generally, if you give a facility to a corporate client, or for that matter any client, you issue him a letter called offer letter. In fact, offer letter is a kind of security documentation. You need to get acknowledgement from your client and file in the security file. What this letter stands for is, the offer letter will have various terms and conditions. Some of the terms are positive, some of the terms are negative. Negative ones are to actually reduce the risk. Because if you become positive and allow customer to do what he wants, customers are risk takers. The higher the risk they take, the chances of default is higher. And when the default is higher, bank is subject to credit risk. So on the negative side, we are restricting the customer for not to take further risk. We'll take one by one. No increase in debt. That means if you have looked at the customer's balance sheet and decided that your debt equity ratio remaining at 3:1, you lend further, not more than that. So you maintain an equity ratio of customers 3:1 all the time. And it is, if that is the acceptable standard, customer will stand even good during old times, because his equity is not going to get completely diluted through that act. So no increase in debts. In the offer letter, you say if you need to borrow money from any other financial institution, first you need to get approval from us. No sale of assets without reduction of loan or equal amount. Certain loans are given for the purchase of some assets. If customer is going to sell that assets and recover that money and not going to have a reduction of original loan facility, we are creating more indebtedness. And as a result, the chances of risk are going to get high and customer will default. No off-balance sheet commitments. That means you even reduce the guarantees and leases to a client so that he is not getting indebted to clients for settlement in the future date. No dividends of an agreed amount. That means even the company is making profit, to reduce the risk of customer's facility, you can say until we authorize payment of dividends, we hereby stop future dividends payments to the company when they issue that letter to the auditors. So auditors will look at and immediately say, okay, company doesn't want to increase, or not, company wants to not to pay the dividends to its existing shareholders. That means shareholders' interest is not looked for, or they have looked for expansion rather than disbursing those funds to shareholders. When you expand, you need to create more money. And anyone who is having that kind of a covenant will need to prove that he is making enough money to pay dividends to safeguard the bank interest. So these are kind of financial covenants, and they are listed in the customer's offer letter. Now, offer letter, I told you, it's a part of security documents. Now we move on to the next mitigation technique of a bank is collateral. When you do the evaluation of a corporate clients, you identify risks. Those risks will tend to, for you to request these three types of collateral, covenant, and price. So now we have come to collateral. Collateral is a security. It's an encumbrance vested in the creditors over the property of debtor for the purpose of securing the repayment of the debt. That means to avoid risk of non-payment, you have taken a security. Here I have mentioned on top collateral. Then in description I have mentioned security. Now I want to ask you a question: what is the difference between the collateral and security? You can do your chat on the other side and let me know your ability to answer my question. The security is generally provided by the borrower himself. That means security is provided by the borrower of his own asset. It's not a third party asset or a company asset. It's the company's or individuals' wealth is being provided as security. Example I can say is, we all bankers, we take housing loans and various type of loans from the bank because we get at a very concessional rate. Just imagine you have taken the housing loan and though you are a banker, they identified you as a kind of a risk. Even if you are a staff member, your salary is being paid by them. They still, when giving housing loans, they will request you to do some collateral. Collateral means you will buy the property and mortgage to bank. And when you mortgage, bank will get a collateral, get a security because it's your own property. Now, if a company does borrowing and one of the directors provide his personal property as security, it is not security because he is not the borrower. The borrower is some other third party. And as a result, he has provided a third party security to the banker. And when that happens, we call it collateral. So either security or collateral is a mitigation method to reduce the risk of non-payment. The security obtained by a bank should have following. It's easy to allow your customer to mortgage his property, but we need to verify various other things. We need to locate and easy to value. That means your valuer may need be able to go and check the every nook and corner of the property and give us the valuation. And also locate means here is accessible to the property. If there's no road access, there's no value. If you have mortgaged something and if at the time of the mortgage, the credit administration failed to check the street line certificate and access to the building or the land, later they might go into trouble because unable to locate means there could be no access to the property at a later stage. And when that happens, you will lose that collateral. And then when you lose that, even in a court of law, if you have failed to analyze the roadway and finally if the customer doesn't have access to the property, value will come down and banker will have to suffer the loss. So it need to be easy to locate and easy to educate margin and steadily increasing value. Now say in Sri Lanka the property values are going up. I'm not sure after COVID what has happened to the property market, but generally properties are getting higher and higher every day. So yet bankers won't fund the full value of the property when a valuer is given. What they do is generally they set up limits, either 65 or 75% of the for sale value indicated in the valuation report, they will fund it. So Other thing is to look at this, easy to realize. To realize there must be a good market for the real estate, and also uh, you need to locate, and you know, to in order to get free of any encumbrances and free of occupants, you need to provide that. That is so. I don't think easy to. It will be easy to realize if we have those things in place. If those things are not there, then the risk will arise when you're trying to realize. So that is collateral. We looked at covenant, we looked at collateral. Now tell me how price can be make a mitigation technique for your risk compensation. This is very easy. We generally say if the risk is high, bank charge is also high. That's why we have a different interest rate for mortgage properties like housing loans compared to credit cards. Credit cards, you have no control over customer. You don't have collateral. Most of the credit cards have been issued without collateral. Based on the transactions you have observed in a client, you allow credit limit. Therefore, good pricing will mitigate to risk certain standard. Now say if a credit card can be charged as 24%, good mortgage loan can be given for 10 based on the risk. So the risks, the pricing requires skill and judgment in order to provide the pricing of a loan. Banks adapt various methods. They can even adapt cost of funds. So you know, banks take deposits on fixed deposits, on current accounts, on savings account, and various type of loan types. Anything taken for credit of current account, bank has the full advantage of using that money without payment of a interest rate, because current accounts are free of interest. Savings account, most of the banks pay something like 4%. In fixed deposits, it's average 10% is paid by bank. So when you take your total deposits and leave out zero interest current account, low interest savings account, and high value fixed deposits, and arrive at an average cost of funds. Total deposits have been so much, total interest what you have paid on so much. Therefore, average rate of interest applicable for deposits will be calculated. That's we call it cost of funds. So you can use in your pricing decisions the amount of funds, amount of money what is going to cost to have that amount of money held in your hand or bank account which is not generating income. So pricing is also a good factor. When risks are high, you charge more. When risks are low, you charge less. And pricing always influence repayment, and therefore you can reduce your risk of corporate clients using fund techniques or the pricing techniques. I want to take a break after explaining this to you. Before that, probably I may have to go to the board again, because this need little bit of explaining to be done. I call them specialized credit or trade finance. Now, most of the corporates might come for working capital. Part of those working capitals are used for trade finance, because trade finance is clients who are engaged in import-export trade. And if those trade need to be funded by banks, they use different type of credit lines. We call it trade finance. Trade finance, compared to a normal overdraft, a term loan, certain advantage bank has. You can link the duration of time taken to complete this trade in order to recover your money. As a result, when the import is done and you give a loan to this customer as a revolving import loans, he may be able to fund this account after the agreed specified period, so that you can reduce the risk of non-payment. Now we are going to trade finance per se, which is import-export trade, and I'm going back to the board. You need to give me a little more time to wipe the current jargon which I have written there, and then we looked at how it is being done in the trade finance. Now, generally, trade finance is done through various instruments, and those instruments are varied. The first instrument generally will say we have a importer who would like to bring some goods from B export in another country. And now he was wondering how he would get those items into A banks with bank B1 and B banks with B2 in that particular country. And initially, they set up a trade arrangements. And as for the trade arrangements, what B does is, he will send the pro forma invoice to A, stating the name of the goods, what he's going to send, how he's going to ship it, insure it, and he will quote a price. Then he will also say the term of payment. So first instance, what we do is, we have a pro forma invoice coming from B. So we issue a pro forma invoice on A, giving all trade terms. In this pro forma invoice, B states term of payment will be a letter of credit. And this letter of credit can be letter of credit site or letter of credit users. So B need, if it is letter of credit side, what A does is, having this performer invoice, he will go to his bank, which is B1, and tell, I would like to bring some goods from B exporter, and he has sent me a performer invoice. In that, he says, I need to get a letter of credit signed in favor of B. So he goes to bank B1, and B1 send the letter of credit signed to B's banker in another country. And the B2, the banker, when he gets this letter of credit, he will inform the exporter B that there is a letter of credit in your favor. So now he has the assurance that once he sends his goods, that as per the terms of this letter of credit, he will be paid. So what he does is, he sends the goods and he hand over documents pertaining to these goods to his banker. We call it bills. Now we'll see the facilities what they ask. This is letter of credit. Letter of credit facility is needed by import. Now B, in order to send goods, he need money. And he can get money by arranging a packing credit. Now, using this packing credit, you manufacture the goods and send it across, and he has the documents for the bill of lading and various titles for these goods, and these bills will be presented to his banker, who will purchase these bills. We call it foreign bills purchase. So once these bills are purchased, he gets his money. From that money, he will request his banker to deduct earlier borrowing of packing credit from the bills purchase. Now goods will come here, documents will come here, B1. If A has money, he can pay the money to the B in order to retire this LC and get this. If he doesn't have money, so originally you establish LC. If he doesn't have money, he will need to get a loan. We call that loan revolving import loan. So they arrange the import loan to him and release the documents to him. He goes to the port and collects his goods. Transaction gets complete. If the terms of credit under LC is usance, he will get a time period. Say 60 days after acceptance. Here the LC will go as a usance LC, and it will reach B1. B1 will inform the B saying, we have got LC, you need to accept that. And letter of credit, they will say that there is a letter of credit in your favor, it's a use and sell seat. That person should borrow money on the packing credit, do the bills. Now these bills have a 60-day acceptance period. That means when these bills come, A will have to accept payment to be repaid in 60 days. So he gets credit of 60 days, and once that 60 days comes, after that 60 days only he will have to part with the money. So you see, he gets a period of credit here. Now this is a letter of credit method. Now he wants to get goods from here. He can ask B to send me the goods direct to me. Don't involve banks. And I will send you money in return. This method we call it open account. Who is taking the risk? A is not taking any risk. B, the exporter. Now say if he switch roles here, and if you are funding the exporter and he does open account transactions, he sends the goods without having any document to claim money, only expect payment once the goods are reaching by the importer, he runs the risk. And if bank fund this sort of a export by way of packing credit, risk is high because the terms of payments are on open credit. So that is another way of doing this trade finance transaction. You also can have collections. DPDA. This guy sends the goods like before, but he doesn't send the documents for him direct for him to clear the goods. What he does is he submits the documents to his bank B2. By submitting, he can even go for a packing credit or bills purchase. Those documents will come here, and it is if it is DP, only delivery against payment, the bank B1 will release documents to A in order to have claim on the goods. So if it is DP terms, this position gets a little bit secured because the bank he use the banking channel, and the banking channel will release documents to the importer upon payment if it is DA. DP. DA means he will make an acceptance here again, delivery against acceptance that he will pay after 60 days or 30 days money. So he will get a kind of assurance. So this is LC is the best method for an importer, the exporter. DPDA also the method where he can get his funds secured, provided if he send on open account, then it will be he's taking the risk. He can avoid any risk by saying, you send me the money. We call it advance payment. Then I will send you the goods. Then the importer is taking risk, exporter is secured. So you will have this sort of either exporter in your customer listing or importer. So you need to assess each and everyone, each of these who is taking the risk. And if higher risk taker take facilities from you, there are higher chance of credit risk. So you need to mitigate by understanding how the LC operates, how the collections operate, how the open account operate, how the advance payment operate. Those are terms of credit arrangements between import and export, and so we call it trade finance, special type of funding by a bank because it involves different type of risk. So you need to understand your client, if it is engaged in import-export trade, the term of credit between import and exporter, and amount of risk involved in that term and how that risk will translate to the bank's risk. So with that, we have concluded the counterparty risk. And when a counterparty is taking high risk, if a bank is funding that sort of a counterparty, and high risk takers will pose a high risk of non-repayment, and as a result, we will have higher credit risk. So you need to understand customers' business well. In our risk identification, that's what we say. In order to manage the counterparty risk, we need to, in fact, get into the shoes of the customer. That means we need to understand his business well as he understands his business. We need to understand more than what he understands. Probably he may understand, he will not understand the risk. He will understand, trying to make profit. So he will indulge more time rather than analyzing the risk, trying to do the business. As bankers who provide facility to this sort of clients, we need to study their business well. And once we know the business as well, we know how to mitigate our credit risk. So with this, I intend to take a break, and we'll meet in half an hour. And I think thereafter we are going to the so far in our credit risk side, we have only looked at the counterparty risk. Now we have a credit risk management unit under the risk management department. They looked at beyond counterparty risk. They also look at counterparty risk when appraisal papers are forwarded to them, but they have to manage another type of risk which we originally called concentration risk, and they also need to manage the counterparty risk taken by business units by reporting and taking necessary actions to mitigate such risk. So I will go into the other side of the coin. We call it other side of the coin in our credit process, called credit risk management, after the break. Thank you. We have finished the counterparty risk. Now we are into other side of the coin in our credit process. We call it credit risk management. Credit risk management, we are mainly trying to, we also looked at the counterparty risk because now, as per central bank guidelines, 35% of facilities what you are granted also come under the review of the credit risk management. Plus, large facilities approved by the bank also need dual approval from credit risk management and also from credit management of the business side. Therefore, we also looked into the counterparty risk at the credit risk department. Apart from that, we mainly concentrate on the concentration risk that the banks undertake and provide policies, the framework, the structure, the integrated level details of management unit will be provided by the credit risk management. Credit risk management also need, one of the way we can actually mitigate risk is to have a proper credit structure. That means with putting right people in right desk of approval, analyzing, giving such a training to those people, are required in that structure. So banks adapt different structures. They will give low type of facilities to be approved by business level people. Then when the facilities get complicated, we pass those papers through credit risk management. Plus, we also might elevate those facility papers to credit committees, uh, and then go to board risk management committees for approval. So, high level oversight of overall credit risk is now being maintained not only by the business unit looking at the counterpart risk, but also looking at the credit risk management department's purview. So moving on to that, we go on to what is credit risk management is. Because credit risk management, what does credit risk management does? In brief, I will explain to you. One of the major is, I told you, concentration risk. Concentration risk comes from industry product specific limits. That means we lend to different type of industries with different risk involved in those industries. So high risk industries, we curtail to a certain extent our exposures. Therefore, if the industry fails, the impact on that failure may not affect the overall bank's credit risk position. Similarly, we apply that particular thing for various products. If you could remember, I was talking about pawning, leasing, various under which products we use to disburse our facilities. So these different products have different risk levels. We consider credit card is a high risk, so we apply high pricing to mitigate that risk. So similarly, in a concentration level, we articulate a bank's credit risk strategy to giving a certain limit based on the overall credit outstanding to those industries and products. So that recommendation to the board of those specific limits, limiting the exposures or enhancing the exposures to less risky products, is done by the credit risk management. So that is one of the major functions of the credit risk management. They also need to draft lending guidelines to support the business. If bank target, will say, not nowadays, if it is tourism, at the time of booming, credit risk department will have to analyze the industry as a whole and decide on type of risks that particular industry confront the lender, and various sub factors on those industries available are lucrative for lending. That means they are risk free and bank can easily target on. So those targeted sectors of a particular industry, banks used to give lending guidelines to the business unit so that they can avoid taking high risk on that. Then credit risk management structure. I told you credit risk can be mitigated or controlled to a certain extent if you put the right people on right desks. Approving authorities with ability to analyze the overall risk involved in a facility and take corrective mitigation action can avoid credit risk to a great extent. So credit risk management structure is placed to independently approve and review large credit exposures which prudential limits are in. We also must concentrate on credit portfolios, and various portfolios need time to time reviews and to see the quality of such portfolio. We'll take, for example, leasing portfolio. At a later part, I'm going to review this leasing portfolio of a bank and see what is our exposure to leasing of motor vehicles. What is our exposure to leasing of machinery? Sometimes we think motor vehicles which can be moved and the lessor cannot have control over it, have a higher risk. But compared to motor vehicles, machinery which are fixed to the ground will remain in a particular place and provide the lesser risk. Actual reviews by banks has not proved that fact. Though it is movables, bank has a better hold because bank will hold the absolute right, absolute ownership. The registered owner uses and the absolute owner has the right to repossess the vehicle without going to courts. I don't know now after these recent incidents where there's been human losses on this thing. Now what is the attitude of banks? I don't know on this portfolio. Maybe probably now it's more risky because with the economic downturn, there will be a lot of defaults under leasing because now there are restrictions to repossess assets leased by leasing companies. Therefore, I think they may encounter a lot of defaults. Credit risk rating system is in place. Most of the banks now have undertaken internal credit rating systems to rate their entire borrowing clientele. Any person who wish to borrow any money need to have a credit rating, and once the credit ratings are established, we may be able to not only evaluate the customer's riskiness based on the rating he gets, we also will be able to input a lot of data for future analysis of how different portfolios of a similar type of rating behave. And those behavior patterns will make us to measure the riskiness of our different portfolios. So credit rating will come into big play in all banks, and most of the banks are now in the verge of not only already they have credit rating systems, but now it has come to a point of validation by outside party of all the parameters what they have taken into consideration in forming these credit rating systems in banks. Interbank exposure limits published on the basis of rating. So this is another area, managing concentration. The credit risk management process also include understanding of the credit strategy. Because when we analyze portfolios, when we consider our riskiness to different type of facilities, products, industries, we will come to a lessons learned position where what is the right type of target market we should put our money. And based on that, generally a credit strategy is being proposed to the board by the credit risk management, stating these type of industries, these products will give you higher return at a lower risk rate. Therefore, we should put more our money onto those. So understanding of credit strategies also part of credit risk management process. Formulation and implementation of credit risk policy, procedures and lending guidelines. We were talking about integrated risk management. In that we said policy, procedure and structure, because those will go from the recommendation of the risk management. Establishment of credit risk management structure. That means we provide the groundwork how approving authorities should be nominated and what kind of delegated authority limits we should be allowed to each and every risk-taking officer. Those things will be recommended by the risk management to the board, integrated risk management, and thereafter we'll have the approval of the board for them to perform based on their ability, and this structure will help to minimize risk to a great extent. Introduction of regular validation of internal rating that I just spoke. Now most of the banks have gone into this mode. Not only they have created the internal rating system, but they want to check each parameter by a independent validator, so that those rating models stand good when the rating is given on a customer, and how those customers perform over a period will be determined based on the rating what they have got. Establishment of credit control process through prudent limits, industry, large exposures, related parties, single borrow limits. These are some of them are actually mandatory regulatory requirements banks need to be complied with, and those will be established by credit risk management and also checked frequently whether those have been adhered by the business unit. Managing credit concentration and specialized portfolios is also a part of credit risk management. So in this credit risk management structure, I mentioned some of the subcommittees before we are moving on to BIRMC, Board Integrated Risk Management Committee. Now, the structure of a risk management unit stand for, at the bottom level, we have credit risk, we have market risk, we have operational risk as the groundwork, and we will have head of department for each of these risks. These head of these departments will report to Chief Risk Officer, and Chief Risk Officer, before he has the access to the Board Integrated Risk Management Committee, going direct from the business line to the board level. But however, in order to communicate well and also to share knowledge and share experiences, lessons learned, and to have future programs implemented, they establish a subcommittee in between. We call it executive committees. Now, where credit risk is concerned, before you reach Board Integrated Risk Management Committee, Chief Risk Officer will report to Executive Credit Risk Management Committee. In this, the members will be the bank CEO or the managing director will chair this, and we will have two sides to it. That is, formulation of policies and communication of those will be done by the risk management team, and implementation of those, most of the recommendations has to be done by business unit. So you get the head of credit coming in, head of credit of various type of credit will be joining in this particular executive committee, sharing the experience in order to create policies, especially the procedures to avoid or to mitigate certain risk what we take, and also to compare various risk indicators in the bank before submission to the Board Integrated Risk Management Committee. So this will be an in-between executive committee. So what does it do is given here: to implement, manage effective credit framework consisting of credit policies and lending guidelines. So these committees will discuss with the business unit, because if only the credit risk department implement all these, they may not be business friendly. So They will bring forward all what they want to do and discuss with the business people and amend accordingly to suit risk-taking ability in a proper manner so that bank will not subject to risk. To manage risk standards such as portfolios, reviews, concentrations, collateral ratings, pricing, provisioning, and compliances also will be discussed at this particular meeting. To ensure business recovery managers follow standard systems and processes to maintain credit quality. Now, you may involve the recovery staff calling at this particular meeting. Head of recovery also part and parcel of this committee, because recoveries will understand and record most of the reasons for default, and those reasons for default or having a credit loss will come with a lot of lessons. Those lessons are embedded in the recovery department, and for risk department to formulate various policies and guidelines, those lessons are very vital. Therefore, we involve a chief officer who is in charge of recoveries also into this committee to share his knowledge and experiences they had with recovery uh, along with the risk department. Apply changes occurring in environment and past experience to determine the bank's credit risk appetite. Sometimes I was talking about risk appetite is the amount of risk bank is willing to take. Now, when prior to this debacles of Easter Sunday attack and now COVID, one of the booming industries where banks would like to get engaged or to fund was the tourism and the transport sectors. Now, based on the environment, we found that those two are not in the amount of credit risk what we are going to take under credit risk, and we have lost appetite for this. So that means we are going to limit our engagement into those industries because we find high risk. Where there is good returns on different type of other industries, our credit risk appetite should grow and embrace those. So those will be discussed at this particular meeting. Risk appetite adjustments to different type based on environmental changes will occur also at this particular meeting. To manage portfolio risks, rewards by type of lending, customer, industry, and geography. To analyze results of stress tests. Now, before we put certain results of the stress tests done by credit risk management unit, it's always better to discuss those scenarios that we have taken into account in doing the stress test, because stress should be done for a potential loss which is going to happen. But it may not happen, but some of the scenarios, business units will disagree on those scenarios. Now, if we take downward trend of a particular industry, whereas business units understand the amount of money which they can earn out of that industry, they will not try to downgrade that particular industry. They will try to remain our appetite high on that industry, and scenario to downgrade that or reduce the limits on that particular industry will be argued by the business unit. So it's better that we come to a conclusion of brainstorming sessions of these scenarios, and these scenarios need business unit people joining, the economist who will also will predict certain things to happen. Along with the risk management, we need to form a stress testing policy and scenarios for each type of risk to be determined at this particular meeting. And if it is executive risk, credit risk management committee, we will only touch the scenarios involving credit at this particular committee. So now we go back to our original understanding and we compare how the business unit matches that. We said risk management process include identification, measurement, and then responding, monitoring, control, and report. If you look at what the business of the credit department of the business, they develop business. While developing business means they will, I told you that they will cherry pick. They will decide which industries we would like to take on board. And that is based on the identification of risk involved. Probably most of the bankers would like to lend against the customer's own deposits. So we identified there's no risk. But apart from the other risks involved in other type of facilities, business development or loan origination will do the identification of risk involved in taking those customers on board. So it is similar to risk identification. Then the evaluation include, you do a credit rating, you apply different credit modules in evaluation, you do ratio calculations. All these are done to measure the probability of default. A customer, where credit is concerned, customer has made a request for a facility, and through the data what you have gathered, you do an evaluation. The original part of the evaluation is actually to identify the risk. But this can be measured by credit rating. And also certain models like expected loss calculation of the proposal based on the customer's rating. Those are actual measurements. If we have identified risk, we have measured them, and then still we think that the risk is less, we approve. Similarly, the measurement in risk department, also what they do is, we also see how the parameters of risk rating being applied to this particular client. And we will see validation of those is right for this particular client. We also see the measurement include expected loss of that particular classification of the rating of this customer. If he's a AAA, we know there's no risk, and this measurement of risk is almost zero, and we would like to lend. So respond is to say yes or no, or to accept or avoid. In business unit, what they say is they put approval, or they will put a decline. And then business units also can't just stop. They may have to actually disperse this facility. By dispersing, they take several mitigation techniques. One is actually collateral management. And most of the banks have credit administration unit to execute legal binding agreement where collateral is concerned. That means they will execute mortgages and register with relevant authorities so that those mortgages can be legally executed in case customer defaults. So credit administration does the monitoring and actually final touch-up for approval, because once they complete this exercise, only actual disbursement take place. So once that is been done, your facilities are already with the client, and that time we need kind of a review. And generally in their annual their offer letter, you say annual review is recommended, or sometimes even a lesser duration is been adapted based on the risk involved. They also they need to provide management information to the hierarchy in the business lines. In the credit lines, you have to monitor, control, and report to board integrated risk management. All these risks what the business development business unit has undertaken in line with credit risk management. So we go into little detail of this process. Now, risk identification. How do you identify a client's risk? Now, originally I went to the risk credit process. In that one side I said credit management, and I said loan origination, then evaluation. Actually, risk will be identified based on the documents and the data what you collected. Data may include his previous facilities with other banks, crib report, status report from existing bankers, then the financial reports what you submit, the analysis of that to your evaluation process. What you do is you carry on a process called risk identification. Now, this risk identification is a great exercise, and you not only need to look at the customer's financial data, his quality data, but we also need, as I told you, we need to actually thoroughly look at the risks which our client undertake. And those risks will affect our client's ability to repay. So those risks I initially said: financial risk, the business risk, macroeconomic risk, and ownership and management. So you need to look at macro level things like ownership risk will be knowledge of bank's credit strategy. Is required to know whether we are going to engage with this client. So risk identifications, this strategy is made based on previous exercises we have done with risk identification of clientele. If our strategy is to move ahead with pawning, that means we have managed this particular portfolio without any losses. So our credit strategies to improve on this particular product. Similarly, if we have benefited from SME lending, bank will create a strategy saying we will convert part of our exposure to corporate client into SMEs. One thing is to diverse the risk. The other one is that strategy has given us higher revenue. So this strategy need to be understood by the risk managers. The economic, the political, social and technological environment in which this customer operates also need to be understood. Because credit risk identification of counterparty, we have evaluated the risk involved in the counterparty. But now similarly, we may have to do that for our own self. Now, take for example, we have this global plug. COVID has taken a turn. The economic activities have paralyzed, and the customers who have borrowed money involved in those economic activities might fail. And final results is all banks will have higher NPA. So now, keeping in mind that environment, expecting high NPA ratios in banks, high NPA ratio means you have low profitability. Then we need to create strategy. How do you avoid? Originally, our risk evaluation and rating of certain clients are based on their current economic performance. But now we are confronted more. We may need to understand the businesses and to engage facilities with them, those who can actually sustain similar epidemics like COVID in the future. Otherwise, we are going to create more and more NPA in our credit portfolio. So we may have to be more vigilant in our approach. However, there will be pressure from various sources because country to succeed, the economy should pick up. Economy to pick up, we should avoid the recession. We must have GDP growth, exchange of goods, and the money circulation should go forward. To do all that, banks may need to provide credit. So having a tight rope on one side, where we think we have a huge NPAs coming in our books from existing clients, taking another set of clients in order to do economic revival, but if they can't sustain their business and they also fall into the earlier type of non-performing, banks will have huge problems. So now risk identification has become a very crucial event at this point. Where credit is concerned, we may need to bring in customers who can sustain adverse events like COVID. Otherwise, those customers also we may have to categorize one day in non-performing. So stress testing need to be carried out based not only on their economic factors, but we may have to look at the unforeseen things. If this happens, how does our client perform? So risk identification has become more and more very sensitive, and setting of risk appetite, risk tolerance, and changing and reviewing credit standards and policy manual, credit procedure manuals, guidelines what we issued also need to be have a second eye because earlier what we thought our credit risk appetite is this much, now we may have to cut down our appetite to certain industries and enhance to certain other industries and set limits of certain products what we undertake, and to do reviews of certain chapters of our existing documentation to suit current business environment, and also to give various guidelines to our business sector is a requirement come under the responsibilities of the risk management. So when you say risk identification, it has become a very vast area for risk management to ponder about under current context. We go into risk measurement. Credit risk measurement is computed by a formula. In this formula, the EL generally stands for expected loss. And when a facility is being proposed, based on the rating of that particular facility and the duration which enjoy, what we do is we compare a similar facility of same nature, which we have records for, we'll say 3 to 5 years, and we have records in our credit rating system that a certain category of rating given to a client, similar facilities have similar where they have performed during the tenure of prepayment. For example, even this I'm going to do another slide because generally this can be explained better on the board. Because first I think I want you to write down today what is EL. EL is expected loss. PD is probability of default, and EAD stands for exposure at default, and there is a typo error here. Instead of PDG, you write LGD. LGD. LGD stands for loss given default. Now, how you compute each one of these three will determine the expected loss out of that particular type of facility. We will do a exercise, and I will come ready at the next session to do a sample on the board and also give you another slide giving an example similar to our corporate credit analysis. I will also have another homework to do on this, and I will take example of a client of a similar rating, how his expected loss being calculated. I will show you. What we are going to measure here is how risky is your borrower. The higher the expected loss is, the higher the risk of that borrower. How much I will be exposed. Exposure at default is the outstanding at that time. When you convert all these, you multiply that by probability of default and the loss given default, you will arrive at expected loss. That will be your total exposure, because in this LGD we also take into account the securities provided. We deduct the realizable value of those. So final net exposure of this facility when it defaulted, taking into consideration recovery of securities, will be determined as the expected loss. So that we need to do exercise and show you how much can I recover if default does occur. Recovery is based on the security. How can I mitigate this risk? Through contractual agreements with the borrower. Now, if you know a customer of, I will also talk about the rating. Ratings are generally based on point system. You can have AAA, AA, single A, triple B, one single B, double B, single B. Then you see these are general accepted ratings what we give. When you talk about AAA customer, that means his creditworthiness is guaranteed. Now, banks get certain rating from a company called Fitch. They will give either AA, double B, or whatever, those based on the risk that particular bank is exposed to. It can be credit risk, it can be market risk, or their capital adequacy. So those taken into account, and they provide that risk. Similarly, what we do to our credit client is we looked into various aspects, their financial analysis, their qualitative analysis, and then we arrive at a point system. And that point system, if a customer can make, we'll say 90 to 100, we will allocate him AAA. Similarly, you goes down from 80 to 90, AA, like that. Finally, we will come to C. C is we also call non-investment category. That means if a customer gets a C, I think our response to risk is to avoid. That means these customers, in other names, they call it subprime. That means you cannot actually make a deal with them. However much you provide money, they will default. So why should we take a risk of such clients? So we'll draw a line. Anything below single B is that bank is going to lose anyway. So we will take B, double B, triple B, single A, double A, and triple A, the 6 categories, and we'll see if under these 6 categories, customers can enjoy different type of facilities. A single A customer can have a lease, he can have a pawning arrangement, he can have a term loan. We will see how these different type of categories of products perform under a singular risk rating. We'll say single A. Single A will say you give a set of customers loan of 1 million, repayable over 4 years. Then you put it into a graph and arrive at and see at what point they default. So, and then you arrive at their NPA ratio. 1% or 2%. And then you can calculate the probability of default. And in one axis, you can have the duration, other one the non-performing ratio, and then you can do a graph and see the probability of default of a similar type of a facility under one single category of credit rating. This requires actually a system to analyze and also data for minimum of 5 years. Actually, once we introduce our credit rating system into the bank's usage, and all the facilities should go through this credit rating system, and the data coming out of the system should be able to give what will be the probability of default of a single A customer on a different type of facility. So this requires a lot of hard work, and we will put a simple exercise next time. I will redo it and come for your better understanding. Then we go on to the next level, which is called credit risk response or approval. You know, the approval is generally given based on the guidelines, if they have followed the guidelines, if they have adhered to the policy manual, and the analysis shows that proper financial evaluation done, qualitative evaluation done, and his customer has passed those all tests, then you approve it. The facilities within the single borrow or related part transaction, this I am going to touch separately next time again. Those are regulatory requirement in lending. Single borrow is the maximum number of the highest level of facility you can give to a single customer or a group customer. There is a regulation for that, and we will discuss that. In the credit rating carried out and the facility fall within the investment rate, I told you, anything below double single B fall into C, and our approval, our response to such rating is to avoid customer. Does the capital charge on the proposed facility acceptable? I told you on our risk management unit also they need to check how much of capital we need to allocate for certain facilities. We discuss when we doing the credit process. Does all counterparty risk of qualitative and quantitative aspects have been adequately analyzed? So credit risk department also run through what business unit has been done once again to see whether the ratios have been properly calculated and the correct questions have been asked from the client and adequate answers are given for the variances in the appraisal form. Does the pricing reflect riskiness? Is it adequate? Now, I told you earlier, if the risks are high, bank price them also high in order to recover most part at a high interest rate. That's what we do our credit card. If the risks are low, if government gives a guarantee on a refinance facility, risk is low. We have customer on one hand who has eligibility has been checked and he's good for repayment, yet the government gives a guarantee and also provide refinance for the facility, then our funds are not involved, then the riskiness is very much low. Those facilities will carry a special interest rate. As the structure is based on customer cash flow and in the form of appropriate product channel. Appropriateness of covenant and collateral in the to risk mitigate that we have discussed in our counterparty credit. If the answers to most of the questions are yes, risk departments approves the facility. So business units generally looked at this analysis of counterparty risk of quantitative and qualitative aspects. But some of the things, whether this customer's proposal adhering to the guidelines, whether it is in the regulatory framework of single borrow limit, all those things will be checked at the risk management unit before they give their approval. So that's where we call it dual approval. Now, the regulatory requirement, I thought I will stop here because I may need to bring in examples and create few more slides to give you better understanding of how these regulatory requirements. MA is maximum amount of accommodation is another word for single borrow limit. Related party transaction is the money which has been lent to your directors, your associate companies, key management personnel are considered as related party. We will see what this it is. Then also we looked at once again capital requirement that need to be set aside for facilities depending on their rating. So at this moment I am going to wind up today's proceedings, and I will be bringing 3 slides additional along with operational risk management session 5 slides next time to go forward in this in my presentation. But next time we are going to do those exercises of credit risk management, that is to look at the corporate level for businesses, their annual reports. We will categorize 4, 3, whatever, which I can pick up. I will set up a chart and I will point out the business model of each one of them, which has helped them to achieve high results. Then we will go on to do concentration risk, how the bank portfolios perform. And finally, we looked at the key credit risk indicators, because to the board, we report, we don't write jargons because board of directors have limited time to look into all the papers what we submit. They need to be summarized and put in kind of a board paper. So generally risk department provide those information through the indicator called key risk indicators, and credit has so many key risk indicators like NPA ratio, provision cover, open credit cover, various ratios are there. Those we will be discussing next time. And also I will, time permits, we'll move on to operational risk management. And thank you very much for today. And next time we'll come here to do some little bit of computations on rating, on counterparty risk of corporate clients, and also regulatory requirements like single borrower, related party, and equity capital. Thank you very much.